Welcome to this series featuring systematic traders. In this series, we will talk to systematic traders, asking them about how they ideate strategies, what works for them, what doesn't, the kind of strategies that they have been working on, and all the nuances that go into creating and trading a systematic trading strategy. A small heads up. Parts of the conversation can get extremely detailed and nuanced, and if you are new to trading, you may need to watch this a couple of times for it to make sense for you. With that, let's get started. This is episode 1, part 1, and is likely to run into a couple of parts. For the first set of conversations, we have Aamodh, also known as GoldenDustbin on X. So, with that, let's get started. Welcome, Aamodh, and it's so glad to have you with us. So, I'll want to start with asking you a bit about your educational and professional background and how did you get into trading? How did it all start?
First thing, thanks for having me here. It's my pleasure. So my name is Aamodh, and I am from Mysore. My education background is in the electronics and communication engineering stream. I did my bachelor's from SJC Mysore, and then I worked at Bosch for 1 year. After that, I did my master's in VLSI design from NITK Surathkal. And after that, I worked at companies like Texas Instruments, Intel, and AMD before I became a full-time trader.
But how did this transition happen? Where did that trading bug come in?
So back in 2016, when one of my friends bought a stock which had fallen big due to some management issue related news and made a decent big amount of returns in a matter of few weeks. Back then, I did not know what stock market was. I knew nothing about the stock market. But when I heard him say that, it kind of intrigued me that money can be made not just out of working in a corporate world, but also in the stock market. So that's when I first heard about stock market, and it stuck me somewhere in my mind that money could be made in the stock market. But then I didn't have money in the first place back then, because this was 2016 when I was still doing my MTech from NIT Surathkal. And so I was waiting to get into a decent, good salaried job so that I can save money and try my hands in the stock market. And 2017 is when I started a decently good paying job. And that's when I started dabbling in the stock market.
But what were you doing in the stock market when you said?
I started by, so I didn't know, as I told, I did not know anything about stock market. No one knows when they start. I Googled how do rich people get rich.
Okay.
And that led me to a couple of things. One, a book by Robert Kiyosaki, Rich Dad, Poor Dad. And two, I read that the richest people in the world invest in the stock market and they let their money compound over time. So I thought, okay, let me get started. I bought Rich Dad Poor Dad, read that book, and then I also started reading up on investing side of things. I bought mutual funds. This was 2017 September, October, November, when market was at the end of a good bull run that started in 2016, sometime around that, and small caps were rallying big. Infrastructure theme was running very good. I had put my money into 3 infrastructure thematic funds because they had done well, right? And then 2018 happened. 2018 Feb is when I think long-term capital gain tax was reintroduced, and also US-America trade war started and market started correcting. What I thought was that I had decent, good, ability to take pain. But then when I saw my investment value erode, I just exited my mutual fund holdings and thought this is not for me. Because right from the beginning, I entered the stock market with the intent of doing this full time, not as just a side hustle. It can be a side hustle to begin with, but long term, I wanted to do this full time. And when I faced that loss with the mutual fund holdings, I knew that if I depended on only market moving up to make money, I could not do this full time, because you have as a full-time trader, you have regular bills to pay, but if your income is not regular, then you are in trouble. So then I decided to try my hands at trading, and I tried swing trading.
Which year was this now?
This is still 2018 mid, something like that.
Okay.
Right. I started doing swing trading, but then I had a job to focus on as well, right? And you can't really do two things in the same 9 o'clock to 5 o'clock window. So then I realized that unless I automate whatever I do in the market, this is not sustainable, and this is not scalable. And if it's not sustainable and scalable, I can't become a full-time trader someday. So that's when I came across some stuff on the internet regarding systematic trading. Until then, I knew nothing. I didn't know that what I was doing was discretionary trading. When I came to know about systematic trading, it felt like it made sense to my requirement in the market, which is ability to automate something, right? So discretionary trading, you can't automate it. Systematic trading, because it's rule-based, you can automate it. And early 2019 is when I created my app on Kite Connect. That's the same app I use even today. And I started backtesting.
So when you say app, you mean a web app?
No, not web app. The Kite Connect API key app.
Okay.
Right. So that's the one.
Oh, okay. That's what you mean.
The Kite Connector developer.
Okay.
App.
Account. Okay.
Account. Yeah. App. And I started backtesting strategies in stocks. And I started a couple of
through historical data.
Yes. Through historical data, which is given in Kite Connect.
Yeah. Got it.
Right. And I started trading these. In the meantime, I also used to do positional trend following in Nifty, which is something I manually backtested because you don't get futures data that easily. And the other thing is that I wasn't skilled enough to, let's say, code a super trend indicator. In this today day of AI, it's relatively easy. But back then, you needed real good coding skills to code an indicator like super trend, which I did not have. And even if I had, I did not have the time, right, as a part-time trader. And I started trading Nifty futures, a positional system based on super trend indicator. In parallel, I used to dabble with this, backtesting and all those things. And by 2019 end, neither was working that well. I was in decent amount of loss, which was death by 1,000 cuts kind of loss, not one big loss, which accrued over 2017 and 2018, 2019. And January 2020, I was almost thinking like, should I even continue this? Because close to 2 years, it's not working. Is it really worth it? And then, they say, luck is what happens when opportunity meets preparation, right? And then the COVID crash happened. The super trend system that I was trading, I was positionally short through that COVID crash, and it injected good amount of money into my account. Until then, whatever losses I used to incur by trading in the market, I used to fund that from my salary savings, because I never expected to be profitable straight away. I knew it wasn't going to be easy, but at the same time, you need to see light at the end of the tunnel to go through the tunnel.
When you some motivation to continue.
Yeah. And this COVID crash really motivated me to continue. But then I thought, in this trade, I was on the right side of the trade. What if I was on the other side, right? And that kind of scared me, because the kind of fall that happened in March 2020 was insane, right? And then I decided, no, positional trading is not for me. I need to do something intraday, right? Because you don't want that adverse gap risk, to be present. Until then, I had tried intraday stocks trading via Algo, automated intraday stocks trading. I had tried mutual fund investing. I had tried stock investing. I had tried stock swing trading. I had tried index futures swing trading. I had tried little bit of option buying here and there. I hadn't even touched option selling, because whatever I had read theoretically said that option selling, infinite risk, finite reward, infinite risk. It just did not make sense to me to try my hands at option selling. But then June 2020, something changed. I came across a retail backtesting online platform called StockMark, and that's where I backtested certain option selling intraday option selling strategies, which later came to be known as time-based straddles and time-based triangles. It wasn't famous back then. One of the traders who was posting stuff on social media, I read his post and got introduced to StockMark, and I tried certain strategies, backtesting certain strategies on StockMark. They looked too good to be true, but I took the leap of faith because until now, what I was lacking was not risk management. What I was lacking was not psychology side of things, not position sizing principles. What I was lacking was good entry and exit rules. You can't make money without having good entry and exit rules, right? And this strategy, which I backtested on StockMark, that really gave me so much confidence that until then I was conservative in the sense I put some money in mutual funds, put some money from my salary savings in FDs, fixed deposits, and remaining I was experimenting. Now the strategy backtest results were so good enough that I exited these mutual funds, I exited fixed deposits, put everything into my Zerodha trading capital account, and started my algorithmic automated systematic trading journey.
But just to point, since you were talking about option selling, was it really about entry and exit? Because you could, technically speaking, enter and exit anytime, especially those days, and still make money.
Yeah.
I remember selling, straddles at 245.
Yeah.
And you could still make money at that time.
Yeah. Right. The thing is, it wasn't specifically about entry and exit, but the thing is, there are multiple parts to become a profitable trader, right? One is entry and exit rules. Second one is sound position sizing methodology, risk management, money management, and you need to have the trading psychology to make this happen, right? So you can have all the pieces in the puzzle, but if you don't have a strategy with positive expectancy, then
absolutely it does not make sense. You can have great psychology, you can have everything, but then you don't have a trading strategy in place.
Yeah, right.
Got it.
The missing piece in my puzzle was found when I was introduced to StockMark, and I backtested and found this really good system on paper, at least, and decided to put all the money that I had and start my journey.
You do sound skeptical to me, generally speaking, as a person. But why did you trust that data so much? I mean, that backtest is like a simple backtest.
Yeah.
So why did you trust it enough to put a larger amount of capital in it?
I'm a big fan of one quote. It says, "No guts, no glory, no legend, no story." You don't get opportunities very often, and when you get an opportunity, you need to take it with both hands, not with single hand. Until then, I was really in search of some good strategy, in the sense something that works, which I hadn't found. And when I found this one, I felt this is my best bet. Let me take the risk. Because even if it does not work out, I have the backing of my salary, right? So, if at all there was a time when I could take a risk, it was when I had a salary, I did not have liabilities.
Makes sense.
And when I was unmarried back then.
Got it.
Right? So I took the leap of faith and just jumped in.
Got it.
And it worked out well.
Great. So, but would you suggest others do this?
As on today, I would say no, because trading is way more difficult than what it was back in those days. Leverage is way lesser than what it was back in those days. The market regimes are not as sticky these days as back in those days. It tends to keep changing more often, probably because regulatory changes keep changing more often these days. So it isn't easy for a trader who is starting today compared to back in 2020.
Got it. So, so let me shift the conversation to, of course, you by accident you figured out this backtesting tool and you found the strategy which you started trading. Fine. But then from then onwards, how did your idea generation approach evolve?
Yeah.
And I'm sure it has evolved because, we don't become good on day one. So, but what was that evolution in terms of how you look at idea generation today? And take me through that process.
Yeah.
And, what do you do once you get an idea?
Yeah.
That's what I want to know.
I'll just briefly talk about my journey from 2020 till now,
Okay.
and then get into how I look at idea generation and all those things.
Sure.
Right. Back in June 2020, I started by selling a nifty weekly short straddle at 9:36 a.m. with 25% stop loss.
9:36.
Yeah.
So it was just a
So,
random number.
Yeah, random number. No real reason why 9:36, but why 9:36 and not 9:35? Because the code that I had written, I used to create 2-minute candles out of the tick data that I get, and my event scheduling used to happen at 2-minute candle close. So I could only schedule it at either 9:36, 9:38, 9:40, that kind of
Okay, got
numbers,
it.
right? So one nifty short straddle at 9:36 a.m. with 25% stop loss, one bank nifty short straddle.
25% on each leg.
Yes, 25% on individual call and put
legs. Yeah.
And one bank nifty weekly short straddle at 9:46 a.m. with 25% stop loss.
And this is every day or irrespective of DT?
Irrespective of DTT, every day, sell straddle, forget.
Okay.
And it used to work beautifully, partly because 2020 June, when I started this strategy, till let's say somewhere around 2021 August, two things used to be relevant in the sense that it was a falling VIX regime. Volatility had spiked up during the COVID crash, and premiums were high and were on a downward trend in the sense that volatility was cooling down over the months. That helped. And two, back then you used to have a good amount of intraday leverage. Someone could sell a straddle for as low as 20,000 per lot, not on Zerodha, but some of the other places. I mean, even otherwise, even on Zerodha, one could sell a straddle for, let's say, something like 40,000 per lot. Intraday, I'm talking about. Intraday leverage used to be higher back then. And that meant that I could risk 1% per trade and 2% per day in this strategy, and could generate decent good returns. That's how I started. And as time transitioned, there's one thing that I follow stringently, is that don't try to fix a problem when none exists, right? So this strategy was working really well. I knew that it can stop anytime. Because you don't back then. I mean, this strategy is a trend following strategy essentially, or a range breakout strategy. And if market trends well, this works. If market doesn't trend well, this does not work.
It should still work, right? I mean, if market doesn't move at all, you should still be able to.
If market does not move at all, it works.
But if it's kind of
hardly
M or W pattern or V pattern, it will kill everything.
Yeah, right. So you hardly get days when market does not hit one side 25% stop loss, both sides 25% stop loss.
Correct.
Yeah, it used to work well until August 2021, and then things changed in the sense that intraday leverage was removed. The intraday price patterns changed. You started to get less trending days intraday, more choppy days. And then I thought, okay, I need to diversify. My knowledge was limited and my options were also limited. Back in August, September 2021, what I did was I just added a couple of more time-based straddles at something like 12 p.m., 12:30 p.m. to manage the reversal days. And then even that kind of stopped working. By stopped working, I don't mean historical max drawdown breached, but it isn't doing the job it is intended to do. And then I went into something else, which is once the leverage was removed, you finally need to get the maximum out of your capital. Short option strategies require higher capital compared to long option strategies. So then I thought, why not figure out something long option, right? And then I backtested range breakouts, intraday range breakouts.
Where did you get that idea from?
The idea is from market observation. The thing is, this idea was not necessarily in sync with market observation because trending days were reducing. But then you wanted to get the returns. You have tasted good returns, and suddenly when the returns dries up, it's difficult to accept it because your ego is hurt. You want to keep getting that return, but market is not obligated to give that return. You realize that over time. I wanted to make good returns still, and I decided, let me try something with long option, right? And range breakouts, they work beautifully.
So for those of you wondering what ORB is or opening range breakout is, check out this particular video where I explain how you could trade the concept of ORB using Nifty options. We were talking about opening range breakout, and you said you tried it by buying options rather than selling.
Yes.
So tell me more about it.
Yeah, so long option ORB is where, let's say you take a time range of 9:15 a.m. to 10:15 a.m. You track, let's say, at the money straddle call and put. If there is a range breakout on either the call strike or the put strike, you buy that option, you buy that strike, and put a fixed, let's say, 25% stop loss on the entry premium. Right? So this strategy had worked really well, and I started this in September 2021 once the intraday leverage was removed, and it used to work well till March 2022. Now, I thought opening range breakout is a directional market strategy. Time-based straddle with 25% stop loss is a directional market strategy. Time-based straddle has kind of started to reduce the returns on capital getting blocked. I was no longer able to risk 1% per day because margin requirement had raised. I thought, why not put this risk of time-based straddle into the range breakouts, long option range breakouts. So until then, I used to risk like 2% per day in short option and 2% per day in long option. I thought April 2022, let me risk 4% per day in long option. And then boom, I hit 20% drawdown. That was a learning for me in the sense that you need to keep your position sizing consistent and should not just increase it, not in search of big returns, not in search of anything else either. You need to have a consistent position sizing methodology. That was a big learning for me then. So I hit 20% drawdown, and then I thought, okay, I have too many correlated strategies that are running. I was running 3 opening range breakout long option in Nifty and 3 in Bank Nifty. 9:15 to 10:15, 9:15 to 11:15, 9:15 to 12:15 in both Nifty and Bank Nifty, highly correlated. I can't believe I used to do that now, but I did that.
Did you backtest these different,
yes,
opening range breakouts?
Yes.
Okay.
Yes, it was all backtested. It was all thoroughly backtested, something that had worked extremely well till then, which is why I decided to size up. But then it stopped. That led me to the world of diversification in a different way. Until now, I thought diversifying across time ranges, diversifying between Nifty and Bank Nifty was true diversification. I was wrong. And that's when I decided to start a non-directional trading strategy.
Okay.
So then I thought, okay, let me sell a straddle at 9:20 a.m. with a 200% stop loss. So market's going to move up. My long range breakout, long option trades are going to get triggered. Now, if market reverses, my short straddle 200% stop loss has not hit stop loss. Long option range breakout loses money, but my short option 200% stop loss strategy, it's going to give me money. Overall, it is going to reduce my PNL variance at a daily level, and that made sense to me. And coincidentally, this short option 200% stop loss straddle had zero expectancy. It was kind of counterintuitive to do this because ideally you don't want to trade a strategy which has zero expectancy. But here it was improving my return to max drawdown ratio in a big way. And so I decided to do that. So this went on, but then the main strategy here was long option range breakout. If that did not work, it did not really make sense to trade a zero expectancy strategy. And long option range breakouts did not work good enough for me to continue that. I moved back to time-based straddles until there was a brief period when I used to trade time-based straddles only on 0DT. Now I again moved back to the normal time-based straddle things. This is probably end of 2022, I would say 2023 beginning. And then suddenly something happened in the sense that regulations changed. 2023 to, I think 2022 mid somewhere, Nifty weekly expiry got introduced. 2023 at some part, mid-cap Nifty weekly expiry got introduced, and then also Sensex weekly expiry got introduced. So from July 2023 onwards, you kind of had a lot of options as far as 0DTE trading is concerned. And I decided to focus on 0DTE trading, which is kind of the T20 cricket of trading world. High risk, high reward, fast paced game. And I decided to focus on that. And that's when I started to develop systems specific to 0DTE short option and diversified it with long option strategies. And I traded it through right till December 2025, when the three Fin Nifty, Midcap Nifty, and Bank Nifty weekly expiries were removed. In this duration, I used to trade only short option 0DT, and it was a very good period for my kind of systems. And then again, starting from 2025, my options were again limited because 0DTs were gone. And there was a brief period of like 6, 7, 8 months when my returns were not up to mark. So this was the period when I also became a full-time trader. Until now, I used to have the cushion of salary income with which I could keep funding in my trading account. Now you don't have that pain coming into your account, which adds a little bit of a risk factor. So luckily, just like luck played a part with regulatory changes, 0DT's introduction in June 2023, luck played a part in the sense that the democratization of AI started. Right now, I was a jack of all trades when it comes to coding side of things. I was a software engineer when I began my corporate stint back in 2013, but not a great coder in any way. With AI coming in, I could now use AI to, get really good code, something which I could not even dream of if I were to do it myself. Right? I started backtesting systems related to cash segment breakout, index futures, commodity futures, stock futures, and also intraday stocks. And now today I trade a well-diversified system across market segments, across intraday and positional, across trending and non-trending strategies. And along with that, I also do multi-asset class investing, which I pledge and use the collateral for trading.
So over this period, how did your idea generation, and not just idea generation, because you would have experienced it yourself, that out of 100 ideas that you get, it's like some 3 or 4 which eventually make it to the production. So how did that evolve, and how did you take an idea from the initial phases to deploying it?
There are 4 stages in algorithmic trading. First one is idea generation phase. Second one is the formulating the rules phase. The third one is you validate those rules. And the fourth one is automation of those rules. Most people think that systematic trading is all about rules. There is no role of discretion in systematic trading. But actually, if you look at it in a particular way, the first 2 phases, which is idea generation phase and design of rules phase, has more role of discretion to play than anything related to systematic in play.
Okay, why do you say that?
Because, see, where do you get ideas from? You get ideas from market observation, or you get ideas from reading some books, and probably the content of that book is derived out of the author's market observation.
Correct.
So ultimately, it's market observation which is the source of ideas. And market observation is very much dependent on the individual's reading of the market, which is discretionary in nature. For example, let's say you are observing that you are no longer getting trending days, you are getting choppy days, or even if trends happen in the first half of the day, it tends to get faded away in the second half, or reversal happens in the second half. Now, your market observation says that trade this somehow and make money. Now, let's take two individuals, individual 1 and individual 2. The other thing is that discretion, when I say discretion, a lot, any profitable trader trades his belief systems. Every trader cannot trade every system. A trader can only trade a system that syncs well with his belief system.
Okay, give me an example.
So someone who is a trend follower, who feels that trend following is the best way to trade, is not going to be satisfied with the, I wouldn't call satisfied, but is going to find it extremely tough to take mean reversion trades. Because with mean reversion trades, you are kind of taking counter trend trades, counter long-term trend trades. So it would be tough for a trend follower to do mean reversion. It would be tough for a mean reversion trader to do trend following, because with the trend following, you need to ride it all the way until it bends, and when it bends, you give back a good chunk of the profit, because you don't know until when the trend ends.
That's the nature of trend following.
Right. So belief system plays a big role in the way you trade your idea. That's another place where discussion plays a role. So let's say that, let me get back to the example which I was talking about. Your observation is that market trends in the first half and then reverses in the second half. Individual 1 can, for example, sell a straddle at 9:30 a.m. and place a very wide stop loss. What he is counting on is the first half trend not hitting his stop loss, and when price reverses, the mean reversion with there is significant time which has played out, and premium would have decayed to some extent, and that would give him the profit. A trend following trader, on the other hand, might sell a time-based straddle with a tight stop loss, which is a trend following strategy, with reference point being something like a 12 p.m., 12:30 p.m. He is betting on second half trend reversal, right? So two traders who observe the same price pattern can design their rules in different ways. So the first two stages of systematic trading, which is idea generation and formulating rules, is very much discretionary in nature. And how much percentage stop loss do you put? 25, 35? How do you decide that? Discretion plays a role in these two stages.
What about optimizing a stop loss and figuring out the sweet spot?
I'm not a fan of figuring out a sweet spot, because it could be overfitting. Having said that, whatever has worked well in the past has got the best chance of working well in the future. The best stop loss that has worked well in the past need not be the best stop loss that works in the future. But then if your strategy is designed on sound first principles, it would still work in future. Need not be the best, but it would still work. So if your focus area is making money and not making highest possible money, I think you need to forget what exact stop loss you pick. Your focus should be on the rules that you formulate, mimicking the idea that you want to trade. That's what the focus should be on, not on the exact stop loss that needs to be selected.
Okay, let's go back to this idea generation structure. So idea generation we spoke about, we said market observation is like the fundamental approach of getting ideas for trading. For those of you who are looking at idea generation, there's a video on idea generation in terms of which are the different sources from which you could get ideas. So do have a look. So back to idea generation. So you would have obviously read books and followed people on social media and figured out a lot of ideas. Yeah. So typically, what do you do once you get an idea? So do you kind of code it and test it, or what happens next?
So when I get an idea, I try to mimic that idea into well-defined rules which can be automated, not just in terms of back testing, but also in terms of execution.
Got it.
Right. So I go back and back test those rules. And what I do is, for example, if I take time-based straddle, and I want to trade a directional strategy.
Okay.
Then I'm going
intraday directional.
Yeah, strategy. Intraday directional strategy. Then I would probably do a sweep of all the parameters involved, in the sense that all the variables involved. One variable is what's your entry reference time, what's your stop loss percentage, what strike do you select, what instrument do you trade with. I do a sweep of all these parameters to get a multi-dimensional tabulation. And then I would look for whether the edge is consistent across majority of the variables. You would get something like, ideally, you would get something like a bell curve. You would have the edge playing out well in majority of the parameters. For example, if I take 15%, 20, 25%, 35, 45, 50%, then obviously with 50% stop loss, the expectancy of a trend following, if your focus is on trend following, then you wouldn't get the same outcome. And the returns would taper out, which is expected, but at least with 20%, 25, 30%, it should have consistently positive expectancy. I do the same across instruments.
Got it.
Nifty options, Bank Nifty, back when FinNifty, Midcap Nifty, and Bank Nifty was there across all. So I select only those systems where the set of the first principles based on which the rules are designed has given positive expectancy, decent calmer across all these instruments, across probably decent good amount of times, and things like that. Because my belief is that a particular price of, let's say someone wants to trade only Nifty and he backtests only Nifty, the kind of price action, when I say price action, two things involved. One is the underlying price action and other is the premium, the price action in the premium, right? The kind of price action that has played out in FinNifty may play out in Nifty in future, right? Let's say you're trading Nifty and Nifty for this set of rules has given good numbers, but the same set of rules has not worked well in FinNifty weeklies, then I would still not trade those rules, because my thought is, what if that kind of price action happens in Nifty? Then I would hit a drawdown, right? So I try to test it on as much data set as possible and trade only those things that have consistent positive expectancy across all these data set.
Two questions here. One is, so what you're trying to, I'm just trying to understand.
Yeah.
So you kind of try and see different parameters, and within those parameters, you will have different, you will sweep it through to check what works, what does not work.
Yeah.
And then what is the final, how do you get to the selection? So let's say, okay, you get that matrix. After that, what?
So it is two things. One, let's say, why exactly 25% random? There's no real reason behind why 25%. The other thing is, I also look at what else do I have in my portfolio of trading strategies. I want to select that parameter in strategy A, which has higher chances of being non-correlated with other strategies in my portfolio. So whichever exact variable I select depends on, one, it's quite random in the sense when I look at it standalone, and two, I select it based on what gives me the best non-correlation at a trading portfolio level.
Okay, but in today's scenario, let's say where we have only two indexes in terms of weekly.
Yeah.
So what do you do?
So in today's environment, it's difficult. That's the reality, right? You have very limited options. You have to live with it, to be honest. But then you can diversify across, index futures, stock futures, commodity futures.
Oh, so what you're saying is move out of this time-based option selling and look for something else.
Yes, you would need to diversify if you are aiming for decent good returns.
Returns or risk-adjusted returns?
Risk-adjusted returns. Yes.
Got it.
Not just returns.
Not just returns. Got it. Cool. Since we're talking about idea generation, there are a couple of questions which come to my mind. So one of the questions is, let's say if there is a product that you're testing, which by itself does not have a major history. Spot has a history, but the weekly options by themselves may not have an history.
Yes.
So how do you deal with it?
The most important thing if you're trading a system is how sound the fundamentals or first principles are. So if a sound first principles system, ideally it's going to work on Nifty, it's going to work on Sensex if it works on Nifty, because the underlying content of both Nifty and Sensex is more or less the same, and the correlation as far as intraday price movement between Nifty and Sensex is quite correlated. I wouldn't say it's very well correlated. Obviously there would be some amount of non-correlation, but it's highly correlated. So one way of looking at it is you have Nifty weekly options data available from, let's say, February 2019, and you can use that as a proxy to evaluate things. The other thing which would probably give me confidence to trade it on Sensex is if the same set of rules has worked on, say, Fin Nifty, Midcap Nifty, and Bank Nifty. That would mean that the rules are fundamentally sound. It is trying to harvest something that exists over a prolonged time. For example, maybe volatility risk premia, something like that. And it is likely to work on Sensex. Just we should do some kind of at least short duration backtest to confirm this thing. But again, there is risk involved. There could be something specific to Sensex, like the exchange is different. There could be execution risks, maybe, I don't know. So there might be something different as well, but there would be a lot of common things if you do these things and it works.
Got it. And how do you deal with that in, let's say, uncorrelated products which exist in commodities?
What I do personally is that I do commodities trading, positional futures, commodity trading, index futures, positional trading, and stock futures, positional trading. I have thoroughly backtested my trend following system on index futures and stock futures. So when I say thoroughly, I'm talking about 10.5 years of data starting from 2015, 11 years of data. And I have backtested it on past 2 years of data on commodity. And this particular trend following system has worked consistently well over wide variety of market regimes and price action regimes over long enough duration, over large enough sample size, and the same thing has worked well in commodities over, let's say, 2 years of data on which I have backtested. So my belief would be that the rules are fundamentally sound as far as implementing the idea of trend following is concerned.
So it's the same, the first principles idea which you're talking about. If it works on one asset, it should work on another asset.
Yeah, the base of a strategy doing good is actually the idea behind it. You can't build a building with loose base, right? The idea needs to be fundamentally strong, and then you can construct the design rules, validation, and execution on top of that.
Makes sense. So I have a related question. So let's say you figure out, okay, something works. You're already trading 3 products or 3 instruments, and then you are adding a 4th one.
Yeah.
So you would also have some position sizing logic, which we will get to later. But then on day one, do you start with your decided position sizing, or you start with like a test quantity and run it, or forward test it for a few months or something, and then go back and deploy?
Yeah. So there are 3 options that you have. One is paper trading, which is you just theoretically note down the trades. Second is forward testing with small size, sample size. This is going to iron out the execution issues. Paper trading will not do that. The third option is go all in full size straight away, right? Personally, based on my experience, I take the second approach. I don't do paper trading because I feel it adds no value. I go with small test size to start with, because I'll tell you an example. So when I did this back in 2021, when I started long option range breakout thing, there were 2 ways you can execute the entries. Option number 1 is what is the range which you're trying to break out. You place a buy stop loss limit order at that upper end of the range with some buffer to guarantee execution. And if the order gets triggered, then the trade gets entered. Okay. That is option 1. The other option you have is monitor these levels in the algo instead of placing an order in the system.
Okay.
Right? So what's the range that needs to get broken out if you want to enter the trade. You keep checking in the algo, in the code, whether that range got broken or not. And when the range gets broken, you place a market order maybe to enter the trade. Now, what I did was, my initial implementation was the second option. I used to track the range in the code, and once the range gets broken out, I place a market order and enter. So what happened was that, in options are quite volatile. It needs no introduction, right? And when a range breakouts, it breaks out crazy big candles.
Because everyone is banking on it.
Yeah. So it breaks out with big candles. Now, if you are monitoring the levels in your code and then placing the order, then there is good amount of few seconds of delay that exists, because of which the slippage would be quite large. So I implemented this execution using this option, and I found that no, this does not work out. It's going to fade away the edge and give you loss over a large enough sample size. And then I went back to my execution code, changed the code to place buy stop loss limit order, and that reduced the slippage big time. Had I gone full size straight away with this kind of execution, I think I would have made more loss compared to what I did now.
Got it.
Right. So that was a learning experience for me to always test execution with sample size. And even there, I take a two-pronged approach. First, I'm going to test out the code by just printing a message when order execution is supposed to happen. So then I test out there is any infinite loop. Again, that's another instance where I stuck a infinite loop and orders kept getting punched and I had to kill the code and do things. So based on those experiences, what I today do is that I test my code, everything with just a print statement instead of actual order execution statement. That's
Got
first
it.
level. To test out if there's any infinite loop, all those things. And second level is going to be to place the actual order itself, small size. You get to know all the practical limitations of execution so that before you trade big size, you have it covered.
Got it. So that answers my question about how you move from idea generation all the way to implementing a strategy. With that, we come to the close of this part 1, where Aamodh shared his journey into the world of trading, and we also covered how idea generation works and his thoughts on idea generation and how to take those ideas all the way to production. In the next part, we will look at the concept of market regimes using 2 examples. One, a long option example of range breakouts, and another example of 0DT option selling, and see how different regimes would impact the outcomes of these 2 strategies. I hope you found this episode useful. Do share your questions, thoughts, and feedback in the comments. We'll do our best to answer them. Thank you for watching and see you in the next one.